We got a double interest rate hike yesterday, a half a point. The Fed raised the federal funds rate. What does that mean for real estate and the mortgage market? This is Dawn and Nicole. We are in the Real Estate Cellar, and we're here to talk about interest rates, how they're changing, and how they're going to affect the mortgage market. How you doing, Nicole?
Depends on what you have to tell me.
Well, here's what I have to tell you. Yesterday, the Federal Reserve raised interest rates not by a quarter of a point like they normally do, but by half a point. We had a double increase, a double whammy.
What is that? I'm sorry. What does that even mean? Like a federal
The
rate?
federal funds rate is the rate that the discount rate that the Federal Reserve charges the banks, and then the banks mark that up.
Okay, so is that good or is that bad?
Well, it's good and bad.
Okay.
Okay. So here's how it's good. It's good because it's going to cool off inflation. We are having insane inflation. I mean, just insane. Look at the gas pumps. You want that price to come down, right?
I don't even want to get into it. I don't even want to I'm angry.
You want the food prices to come down, right?
I would love the food prices to come down. $200, $300.
This is going to cool off the economy, which is hopefully going to lower the price of gas and food.
Okay.
But
there's a caveat.
There's always a but.
Okay.
It's going to raise the price of credit. So the short-term rates on your credit card.
Oh, the APRs?
Are going to go up. Car loans. So if you buy gas and food on your credit card, even if the price goes down, you're going to pay a higher interest rate if you don't pay it off right away. So it's going to end up costing you more. Yeah, that's how it works.
Wait. But you lock that in, don't you? Typically?
Why do you have a locked-in credit card? Your credit card
rate, the APR
doesn't fluctuate.
I thought it stays the same. I don't really check it.
Okay, it can. You could have a fixed rate credit card, but for the most part, credit card rates are not fixed.
Okay, so what about...
That's not typical.
What about the mortgage rates?
Like if you go to a credit union, sometimes a credit union will fix your interest rate on a credit card.
Now I'm worried.
You get like an introductory rate, like for the first year, they'll keep it at 2.99%, but then it'll fluctuate with the federal funds rate.
Now I got to pay attention to my stuff.
Oh, you weren't paying attention to this
before?
before?
No, I'm sitting here thinking, oh man.
Were you guys paying attention to this before? The interest rate on your credit card? You probably just, whatever, this is how much I owe. What's the minimum due, right? That's what you were thinking?
I'm despondent. What else okay, so mortgages.
Right. So why is this good and why is this bad? We have to cool the economy off because the price of gas, the price of food can't keep going up. We have to save the dollar in a way. Save the dollar. We don't want to have, that Zimbabwe moment where all of a sudden we need $10 trillion to buy a loaf of bread. You don't want that.
Okay.
Right?
I was like, where are you
going
going with that?
If you don't want that to happen, they have to raise interest rates a little bit. But it hurts when they raise interest rates. And what does it do to the mortgage market? Well, it doesn't affect it directly.
Okay.
It's not a direct hit on the mortgage market. It's an indirect hit on the mortgage market.
Okay.
Because the mortgage market is affected by the bond market, which is not set by the Federal Reserve. It's set by the free market. Or supposedly the free market. It's supposed to be free market.
Two independent systems. Fed goes up. Mortgage rates are up or the same or down?
Right now, right this minute, they're the same.
Okay. All right.
And they haven't really gone up yet. I just checked this morning. They're actually a little lower than they were last week. A drop lower. But they change on the day. So by 5 o'clock, they could be higher.
So right now
the Dow Jones is down over 600 points when I last looked.
What about inventory? So we have the mortgages that are kind of, the rate is kind of the same.
Well, it's much higher than it was 2 months ago. It's like 2 points higher than it was 2 months ago.
But as per last week.
But here's what rate the Fed raises the rates does to the psyche of the American buyer. It goes...
We're getting psychological people. Hang on a second.
We are.
Getting it in the mind.
Well, that's what it is. It's all like, it's all Jedi mind trick over here. That's what's happening. What's happening is people go, oh, I was going to buy that house. Let me offer $1.5 million, and here comes the federal funds rate, and we're going to raise it half a point. Not so fast.
Not so fast.
Let me pull it back. Let me pull it back. Why? Because even though I'm paying cash, rates are going to go up. So other people aren't going to be able to compete with me. So I might be able to get a better deal if I wait.
Oh, so are people waiting?
It depends. I mean, how bad? A lot of people need a place to live. Like right now, there's nowhere to rent.
No,
That's
there's not.
why
There's not.
that's what the demand is all about. I mean, the housing market is still all supply and demand. There's still money out there. There's still cash buyers. And there's still these companies like Ribbon or the Mortgage Mom or these people who will give you a cash offer letter so you can still buy the house with cash and then get a mortgage after the fact.
Has that slowed down at all?
I talked to one of my mortgage lender friends. They're down 90% on refinances.
90%?
90%.
On refinances, though.
Yes, on refinances, but that's a good portion of the mortgage business.
Oh.
It's a huge portion of the mortgage business. I mean, think about it. There's not really a whole lot to buy. So purchases aren't, I mean, when I did appraisals, a lot of the business came from refi. Much more came from refi than purchase.
So,
Much
ouch.
Yeah, 90%. It's huge.
They're hurting.
But what we're talking about is the housing market in 2022 and what the forecast is for it. And I'm thinking that for the rest of this year, we're going to see it cooling off. We're going to see prices come down. We're going to see a longer days on market.
Do you think there would be a housing crash or a crash or
a full housing market crash? I don't think we're going to get it. I just don't, not yet. Maybe not this year, maybe next year. But I don't think we're going to get that this year because we don't have any rentals. The new constructions aren't happening fast enough.
supply?
People still don't want to live under that bridge. They're willing to pay. Yeah, is it going to hurt? Yeah. Is it going to cost them more than it did before? Yeah.
Coupons. Start cutting them
Our
down.
price is going to come down? Yeah. But prices coming down and a housing market crash are not the same thing.
Okay.
You know, real estate prices and the price of houses can come down a little bit and we're not going to see a crash. They can go back down to where they were 2 years ago and that's still not a crash because they were really high 2 years ago.
Okay.
So that's called softening. Now, if we go back to 2015 prices, that's a crash. That's a crash to me. I think that's a 7 years ago. That the prices would have to come way down. The inventory would have to go way up. I mean, more than double. For that to happen. So, are we in a housing bubble? Bubbles are caused by artificial demand.
What is a housing bubble? I don't understand what that is.
A housing bubble is when prices are inflated more than they should be by artificial demand, but the demand is not artificial. Do you understand?
I thought they were inflated because of the business guys, the investors, those people that have cash money. They've been actually pushing those the battles back and forth with the price gouging, isn't it?
The investors that are buying, Blackstones and all these people that are buying and they're buying the houses because they're buying them to rent them. They're not going to fire. Whoa, wait a minute. They might fire sale them. I'm thinking that these companies are not going to fire sale the houses when the prices go down because they don't have to. They can just keep them and rent them, ride out the recession. But guess what we are seeing? We are seeing Zillow doing a little bit of a fire sale on their stuff that they bought. So maybe some of the iBuyers will fire sale. I mean, Zillow's in a little bit of a different situation, because they wanted to get out of it. They just want out from under. They just want to sell it off.
So they bought too many houses at a higher price?
They bought too many too fast without a good plan of how to dispose of those houses.
And nobody's buying it?
Well, that's what they're saying.
Nobody's buying it?
Oh, no, people are buying them.
So I don't understand
but
why would they do it.
They're selling them for a lot less than I think they thought they could because they want to get rid of them quickly.
Oh, okay. So they put a higher price on it and now they can't sell it at that price.
Well, that's happening all over the place right now. I mean, I'm keeping my eyes on the housing market, and that's what I'm seeing everywhere is the agents have said, oh, let's push up the price. Let's push up the list price. Push up the list price. And
3 times fast.
I can't say it 3 times fast. I can't even say it 3 times one time fast. It's not even happening.
In this local market, I have noticed that there were like $250,000 houses as of last year in around January to March-ish. And now they're $500,000.
5 and 6.
Right.
And at 5, they need work.
And they need work.
That's not sustainable at 5% interest rates.
I had one gentleman say it needed a total gut, and he was only willing to go down to $470K. And I was like, what am I supposed to do here as a normal Joe Schmo?
You're supposed to not do that.
So
just don't do that.
But that's the inflation we're talking about.
But that's going to end quickly, because the first thing that I think is going to happen when this softening happens is those houses that need work, the unsellables because they're priced too high for the amount of work they need, they're going to come more back down to earth. Because if the seller really needs to sell them for whatever reason, they'll be like, you know what, all right, I bought this thing 10 years and I really know I can still make a profit at this much, so let me just dump it.
Oh, that's fair.
You know, I don't want to pay the taxes on it, I don't want to fix it up. And so maybe the psyche thinks that they lost money, but you don't lose money if you haven't sold something, right? So, and you don't make money if you haven't sold something. So if I bought a house for $200,000 and I think it's worth $1 million now, but I never sold it for $1 million, I didn't make the difference. I didn't make the $800,000. I end up selling it for $750,000. I didn't lose $250,000. I still made $550,000.
Yeah, that makes sense.
You know, you don't make that's why the IRS doesn't charge you money until you realize the gain. You don't get charged money on unrealized gains just because in your head you thought you made money. Unless it's in your hand, you didn't make money.
So I think that's an excellent subject for next time, because I don't know anything about realized gains. So maybe perhaps stick with us for next episode. And
next time we'll talk about realized gains and how to pay taxes on them. Or not.
Taxes.
If you want to keep up with what's happening in the mortgage market and the housing market, please like and subscribe to our channel. We'll keep you up to date. You keep coming back here and we'll tell you everything you need to know about the housing market and where it's going.